The rich don't win because they are smarter. They win because the game was built for them before you were born. Not metaphorically, not emotionally, mathematically. Every economic crisis, every unexpected market crash, every sudden inflation spike, every war that reshuffles resources, it looks chaotic from the outside, random, tragic, unpredictable. But what if it isn't? What if inequality isn't a flaw in the system, but the system itself? Why is it that when markets collapse, small businesses disappear while billionaires double their wealth? Why does debt suffocate the middle class, but empower the elite? Why do recessions feel like disasters to millions and like clearance sales to a few? This isn't about conspiracy. It's about structure. It's about incentives. It's about understanding the invisible mathematics that silently transfers power upward decade after decade. There is a pattern. There is a strategy. And once you see it, you cannot unsee it. Tonight, we're not talking about motivation. We're not talking about hustle culture. We're talking about architecture. The architecture of advantage. And why, no matter who is elected, no matter what ideology dominates, no matter how loud the promises, the rich always win. Before global finance, before digital markets, before corporations spanning continents, power was visible. In ancient empires, wealth meant land. Land meant food. Food meant control. Kings and aristocrats didn't hide behind complex systems. They owned the soil and the people working it. Feudal Europe operated on a simple equation: protection in exchange for labor. The nobility controlled land. Peasants produced. Surplus flowed upward. It was crude, but transparent. Then trade routes expanded. Merchant families rose. Banking emerged. And something shifted. In Renaissance Italy, powerful banking dynasties learned a new truth. Controlling money was more powerful than controlling land. Credit could shape kingdoms. Loans could fund wars. Debt could bend monarchs. Empires began to run not only on swords, but on ledgers. Fast forward to the Industrial Revolution. Factories replaced fields. Machines amplified output. Productivity exploded, but ownership of production remained concentrated. Workers were paid wages. Owners accumulated capital. The gap widened not by accident, but by design. Profit flowed to shareholders. Labor received compensation, not equity. Then came central banking systems, national currencies, bond markets, stock exchanges. End quote. The game became more sophisticated. We were told it was progress, efficiency, growth, and it was. But embedded inside this progress was a quiet rule. Those who own assets benefit from expansion. Those who sell time survive it. The world before manipulation wasn't innocent. It was simply less complex. Power was obvious. As systems evolved, power became abstract, institutional, legal, algorithmic. No longer a crown on a head, but shares in a fund, influence in a boardroom, leverage in a balance sheet. And slowly, invisibly, a hidden order emerged, one where crises were not equalizers, but accelerators. Here is the first truth. Wealth compounds. Labor does not. If you earn money by selling time, your income is linear. You work 1 hour, you get paid once. Even if you are highly skilled, there is a limit to your hours. But if you own assets, businesses, stocks, real estate, intellectual property, your money earns money. And when crises happen, asset prices temporarily fall. Who has liquidity when prices collapse? Not the indebted middle class. Not the paycheck-to-paycheck worker. Those with reserves. Those with access to credit. Those protected by institutions. History shows it clearly. After financial crashes, asset prices drop. Fear spreads. Small investors sell. Companies cut costs. layoffs increase. Then, central banks inject liquidity, interest rates fall, cheap money flows into markets, asset prices rebound, often higher than before. Who benefits most from rising asset prices? Those who already own them. This is not a secret document hidden in a vault. It's public data. After major recessions, wealth concentration increases. Not because billionaires caused every crisis, but because the structure rewards ownership during recovery. The system absorbs shock and redistributes advantage upward. And here is the twist. The rules are legal. The mechanisms are transparent. The math is undeniable. Compound interest, equity ownership, tax incentives for capital gains, access to leverage. It's not dramatic. It's structural. And structure is more powerful than intention. Let's break it down. Feel. Imagine a market crash. News headlines scream panic. Retirement accounts shrink. Businesses close. Fear spreads through streets and screens. A restaurant owner loses customers. Revenue drops. Loans still demand payment. Eventually, the doors close. Behind the scenes, private equity funds analyze distressed assets. They purchase struggling companies at discounted valuations. Restructure, consolidate, scale, reveal. When interest rates are low, borrowing becomes cheap, but not for everyone equally. Large institutions borrow at favorable rates. Small businesses face stricter conditions. Capital becomes selective. Governments announce stimulus packages. Officially, they are for stability. Unofficially, large corporations with political access navigate the programs faster, more efficiently. Connect. Now zoom out. Every cycle repeats. Expansion, excess, crash, liquidity injection, asset inflation. If you own assets before the crash and can hold through volatility or buy more at the bottom, you exit stronger. If you rely on wages and lose your job during contraction, you exit weaker. Expose. This is the asymmetry. Risk is socialized, reward is concentrated. When systems are too big to fail, losses are mitigated collectively. When markets surge, gains remain private. Look at housing markets. During downturns, foreclosures rise. Properties are sold under pressure. Investment groups accumulate portfolios. Years later, rents increase. Look at stock buybacks. Corporations use profits, sometimes borrowed money, to repurchase shares, increasing share value. Executives holding stock-based compensation benefit directly. Look at tax structures. In many systems, capital gains are taxed differently from earned income. Long-term ownership is rewarded more favorably than labor. None of this is hidden in a dark room. It's written in policy, embedded in regulation, protected by lobbying, maintained by influence. Feel the scene again. A young graduate enters the workforce with debt. He works. He saves slowly. Inflation erodes purchasing power. Housing prices rise faster than wages. Meanwhile, asset holders leverage appreciation to acquire more assets. The gap widens not because one is lazy and the other brilliant, but because exponential growth outpaces linear effort. Everything fits together when you understand one principle. Ownership compounds. Dependence compounds vulnerability. Now, here is the larger pattern. Over centuries, the form of power changes, but the principle remains constant. Aristocracies became industrial magnates. Industrial magnates evolved into multinational shareholders. Empires transformed into financial networks. The visible faces rotate. The architecture endures. Central banks stabilize currencies, but also influence asset prices through monetary policy. Investment funds manage trillions, allocating capital that shapes industries. Think tanks draft frameworks that influence legislation. Lobbyists Translate corporate interests into policy language. No secret handshake required. Just aligned incentives. If growth depends on asset inflation, policies will protect asset values. If retirement systems rely on stock markets, governments will avoid prolonged declines. If political campaigns depend on funding, major donors gain access. Continuity doesn't require conspiracy. It requires interest. And interests cluster. Elite universities connect future executives, policymakers, financiers. Networks form early. Opportunities circulate internally. Information travels faster within closed circles. It feels inevitable because structurally it is self-reinforcing. Capital buys influence. Influence shapes regulation. Regulation protects capital. And so the cycle continues. The rich don't need to win every battle. They design the terrain. Does this power still exist? Look around. Investment giants manage sums larger than national GDPs. Conglomerates own media outlets, pharmaceutical firms, defense contractors, technology platforms, sometimes simultaneously. Digital platforms harvest data, the new oil shaping behavior through algorithms invisible to users. Information itself becomes leverage. Markets react in milliseconds to signals ordinary citizens never see. Artificial intelligence optimizes trading strategies beyond human speed. Wars no longer require territorial invasion to shift power. Economic sanctions, supply chain disruptions, currency fluctuations, these are modern weapons. Financial influence can destabilize governments without firing a shot. Meanwhile, individuals are encouraged to consume, to borrow, to invest emotionally rather than strategically. The narrative focuses on personalities, but the structure remains untouched. The question is no longer whether inequality exists. It's whether the system can function without it. So why do the rich always win? Because they play a different game. They don't trade time. They acquire leverage. They don't react to crises. They prepare for them. And most importantly, they understand the rules are not written for fairness. They are written for stability of power. This isn't a call for anger. It's a call for awareness. If inequality is engineered through mathematics, strategy, and structure, then understanding those structures becomes the first act of independence. The real question isn't whether the rich will continue to win. The real question is this: now that you see the architecture, will you keep playing blindly? Or will you start studying the blueprint?